Many of our retirement accounts are what is known as self-directed, meaning we have to choose the investments inside the 401ks, 403bs, 457s, the TSP, et cetera, et cetera. But when do you change your investment allocation before you move into retirement? I'm here with financial advisor Robb Rothrock. He's the founder of Rothrock Financial Group. Let's ask him. Rob, how you doing today?
Hey, doing great. How are you?
I'm very good. These self-directed accounts, they don't really come with a warning flag or a text message that says, hey, you know, you're getting closer to retirement. When do we change our allocation?
Yeah, that is a really good question. And you're right. There's a lack of awareness or a lack of education around those, and companies largely sort of just leave it. They might have one meeting that happened years ago when they were a new employee, and that's the last time they ever heard or talked to anybody. And so these accounts are, a lot of times, they're just left on autopilot. And more often than not, people really don't know what's in there. One thing we see a lot of are target date funds. But I'll ask people, have you looked to see what's inside of your target date fund? And most people don't. They don't even know that there's something else inside that target date fund. So we see a lot of overlap. We might see, because there's additional funds inside those target date funds, you might have 3 or 4 that are invested in similar things, and there might be more risk going on in that portfolio than they realize. So even if they're years away from retirement, it's important to at least meet with somebody that can have an objective look at it, another set of eyes on that to give them, even if they don't do anything, so at least they're more aware. So I try to bring awareness to people to help them understand at least what they have. And then then we can also do a risk assessment after we find maybe they have a pretty conservative risk tolerance, but we find out that their portfolio is a little bit more aggressive, or maybe a lot more aggressive than they realize, and maybe they're going to retire in 2 years. Well, we need to flag that fairly soon in that relationship, so they're at least aware of it.
What I've found is that when you speak with a lot of folks, I'm sure you've experienced this, is that they picked those funds in those retirement, because you said portfolio. I think people look at the funds, they maybe open up another tab, do a little bit of research, look at the earnings and how they've grown and so forth. They pick those 10 funds and they leave them for 10 or 20 years.
Yeah, I see
so
that
is that what you mean by the portfolio?
Yeah, exactly, like a 401k. We see that a lot. Yep, they just leave them there, and then they never really pay attention to it again. And the other thing is that the market's done, with a few blips here and there, with COVID being the biggest one, but for the last 8 or 9 years, the market's done overall fantastic. And I've even kind of see a little bit of complacency. People have kind of forgotten that it doesn't always do that. And one of the bigger risks in waiting is if there's a major market correction either a year before or early on in a retirement, that can have a dramatic impact on the quality of that retirement. And so that's why is it time to make a change? Well, not necessarily without looking at the details, but it might at least be worth having a conversation, even if you're 4 or 5 years out, so you understand where you're at.
You said not too many bad events, except besides COVID a few years ago, but I'm not too far away, and no, you're not, from 2008 as well, though.
Oh, yes.
I mean, think about the folks who wanted to retire. Let's say, I'm going to retire at the end of this year. They ended up having to work another 5, maybe even more years to make that back
I
up.
have one of my best friend's father was a longtime employee at a large company in Texas, and he experienced that. And what happened in 2008, there was such a market drop, and then it continued for so long that people hang on as long as they can, knowing that they shouldn't sell, and then they ended up selling at the absolute wrong time. And that happened to him, and he never really recovered from it. And even to this day, it's affected the quality of his life, and having seen him and what it's done. And so and I don't think he had an advisor, so he didn't have anybody to bounce that off of. And he just, you panicked at the wrong time. But maybe a reallocation earlier could have avoided some of that. He had a whole lot of money tied up in one company's stock. I see that more often than you might think. And people get emotionally attached to that company, but that company's stock price has nothing to do with how you feel about it. So that can be a very dangerous situation to be in. It looks great until it's not. So, there's definitely... There was a reallocation there would have done him some good. But
I'm going to go ahead and say it for you, because there's a phenomenon in behavioral economics known as the behavioral biases. This one I think you're talking about is familiarity bias.
That's true. Yeah.
The things that we are more familiar with, we like to invest in here in Texas, energy, oil, gas. I'm not saying that that's what that was, but we tend to choose those stocks inside our retirement accounts. You work there, and when the industry does have a decline, you're there trying to make that back up for sometimes years.
Right. And one of the things that's also, there's a bit of a misunderstanding that people are wired to think about growth as the number one objective of a retirement account, not necessarily thinking that at some point this has to turn into income. And there are ways to invest in future income even if you're years away from retirement. And the earlier you do it, typically the more that income will be. And so you're getting growth in another sense, but it's more predictable and it's less tied to what the market does. And so if retirement's anywhere on your radar, it's at least worth having a conversation.
All right, Rob, thank you very much. This was Robb Rothrock. He's financial advisor and the founder of the Rothrock Financial Group. When should you change your allocation before you move into retirement? We want to take a look at it, I want to say a few years before you retire. Big, huge red flag for sure. If you're a year out from retirement and you haven't looked at your 401k and how it's allocated, you should do that. One of the best ways you can accomplish that is by calling the phone number right now on the bottom of the screen, setting up your complimentary income plan appointment with the team here of the Rothrock Financial Group. So dial that phone number, or if you want to, you can schedule a time at the website right here, Rothrock Financial Group or rothrockfg.com. Thanks for watching.